Hello, today we are going to calculate goodwill under the method super profit method. Now, what is super profit? Here, what is super profit? Super profit is nothing but any profit earned by the firm more compared to the peers, right? If there are number of firms which are working in the industry and one firm is earning more profit compared to the other firm on the same capital employed, so that is called super profit. In the formula we can find out super profit is average profit minus normal profit. Now average profit is the profit which is earned by the firm for which we are calculating the goodwill, and normal profit is earned by any firm in industry, right? Or we can say normal profit of industry. Normal profit, right? Let's say we are saying in energy industry means, let's say the profit is 10% and one of the firm is earning 12 or 13%, so that is the 3% or 2% extra is called super profit, right? Now what happens for the normal profit? Normal profit is calculated on capital employed, right? Capital employed. What is capital employed by the firm? We have to find out. Now capital employed, you have two approaches to find out the capital employed. So first, super profit is nothing but average profit minus normal profit. Normal profit is any profit earned by the firm or the industry, right? And normal profit, we have two approaches. The one is liability approach. You can find out liabilities approach, and the other one is asset approach. The word seems to be bit difficult, but nothing. On the basis of liability you can find out the capital employed, and on the basis of the asset side in the balance sheet you can find out the capital employed, right? So in the in the liability side, you have to take the capital plus reserve and surplus, right? Capital plus reserve and surplus, and minus, you have to deduct non-trade investment any goodwill or fictitious asset which is appearing, in the balance sheet. So you have to deduct that, right? Non-trade investment, fictitious asset, this is your liability approach. In the asset approach, what you have to do is, so asset, that is total asset minus goodwill. If any goodwill is appearing, then fictitious asset non-trade investment, and minus outside liabilities. So this is the formula, right? Capital, reserve and surplus. Capital, reserve and surplus, non-trade investment, goodwill and fictitious asset. Fictitious asset you have to deduct. In the asset, अगर आप asset approach से करते हैं, तो asset approach में you have to take the asset and minus goodwill, fictitious assets, non-trade investment and outside liability. You have to deduct. So this will give you your capital employed, right? Capital capital which has been employed in the business to earn profit, right? So let's see one of the question so that you can understand more. How do we do that? Let's take the question which is given in the TS Grewal super profit method, right? So we will take a question wherein we have to find out the capital employed as well. Let's take question number 16, right? It is a bit longer than other. It says Amit and Karthik are partners sharing profit and loss equally. They decided to admit Saurabh for an equal share in the profit, and good that the firm is to be valued at 4-year purchase of super profit. First, we have to find out the super profit, right? The normal profit, the normal rate of return is 12% per annum. Average profit of the firm for the last 4 years has been given 30,000. Calculate the share of goodwill. So what we have to, average profit is given. Average profit we have been given. Average profit for the firm for the last 4 years is 30,000. So this is given. Now we have to find out what is the normal profit. Normal profit of the firm, right? And normal profit is given. It is 12% per annum. 12% on the capital employed. Now we have to find out the capital employed. Capital employed, we can find out from any of the way. So from the liabilities side or liability approach, capital employed would be equal to. Now what would be our capital? The first thing is share capital. Share capital is given 1,40,000. 1,40,000 is the share capital. Then we have been given general reserve. General reserve is 20,000 given in the question. This is question number 16, right? And general reserve. So in the liability side, we have to take the reserve and surplus minus any kind of fictitious asset. So we don't have furniture, stock, debtors, cash. We don't have any kind of fictitious asset, right? So this is it. So this is 1,60,000. So our normal profit would be 160. 12% of that. Solve it. 0.00007. 19,200 is the normal profit, right? We are getting 19,200. So super profit, we know that super profit is nothing but average profit minus normal profit, right? Average profit given in the question 30,000 minus normal profit we have calculated 19,200. So difference of that would be our super profit. So this is 10,800. 10,800 is our super profit. Now goodwill would be number of years of purchase, which would be given in the question, multiplied by super profit is equal to number of year of purchase is given in the question 4 years. 4 years multiplied by super profit we have calculated. Super profit we have calculated here 10,800. So this is 40,200. 40,200 is your goodwill, right? So this is how we are calculating goodwill on the basis of super profit. So I'm taking it through again. So in the super profit method, we have to calculate goodwill with the number of year of purchase multiplied by super profit, and super profit we have to find out. Super profit is nothing but difference of average profit minus normal profit. Average profit is the profit which has been earned by the concerned firm for which we are calculating the goodwill. It will be given in the question, right? Or we have to calculate average profit. Now normal profit is the profit which usually earned by the different firm working in the industry normally, right? So in this question, normal profit is given 12% of the capital employed. Capital employed we can find out from the two approaches, liability approaches or asset approaches. The formula was given to you, right? And the capital employed here is share capital plus reserve and surplus, which comes out to 1,60,000. And normal profit would be capital employed multiplied by the rate of return, that is 12%. That gives us the normal profit, which is 19,1200. Now super profit is average profit, which is given in the question 30,000 minus normal profit, which is calculated 19,200. So super profit is 10,800. Now goodwill formula is goodwill is equal to number of year of purchase multiplied by super profit. So that gives 4. Number of purchase has been given in the question 4 multiplied by super profit.